I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this is a first deal episode where we walk through what it takes for someone to find, fund, and close on their first apartment complex. And if you're an aspiring investor yourself, you are probably trying to do exactly the same thing. So before we get to this episode, make sure you hit the subscribe button below and the little notification bell to make sure you get notified every single time we post a new episode. And now, enjoy the show. When you're choosing what sponsors to partner with, what are the important things for you?
Well, first, until you know them well enough to ask for their underwriting, right? It's the person, right? The jockey is what matters the most. If you have a bad jockey, nothing else matters. If you have a good jockey, everything else should fall into place. But trust but verify, right? So conservative underwriting, which is so easy to say, what does that mean? I would say I would rather be pleasantly surprised than not get my money back or get stuck with a deal when the funding is running out and interest rates have just increased. So conservative underwriting and exit cap and rent rate, market research, the market, where it is, are jobs coming there, people moving there, households being formed. And then I separate, there's three things: jockey, market, and the underwriting, but I pull a fourth one out and very specifically look at a deal's fee structure. If I see an operator getting paid all their money up front or in fees, I want to see what their motivation is for doing a good job with the deal. They've gotten paid. How much do they care is on the other side.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. We've got the one and the only Melanie McDaniel with us. So Melanie, welcome to the show.
Thanks. Happy to be back.
Happy to be back. Absolutely. And I'm sure everybody here realizes, but this is our second appearance. Her first appearance was with as an aspiring investor with Keely Hubbard as the experienced investor, who incidentally, we got a selfie, all three of us together at Best Ever 2 weeks ago. So that was fun.
Yeah.
So tell us a little bit about yourself and where you're coming from and what got you into apartment investing.
Yeah. So I'll try to be fast because there was a lot that happened. I grew up in blue collar, Utah, and went to school, got great grades, whatever, but I didn't really know what I wanted to be when I grew up. I just knew I wanted to travel. You'll see this theme through my whole story, but I joined the military because I thought that was my best opportunity to travel. Yes. My first duty station was in Italy. So that checked the box.
Oh, man.
Money for school, get out from under my parents' wings, be on my own, stand on my own 2 feet, and then grow up because I really had no idea what I wanted to do. So 4 years in the military. And then as I was getting out, I knew college was the next step, right? Because that's what I was told to do, go to college. So that was the next step.
Yeah. You gotta follow the pathway set before you, so go to college, get a good job, stick in a career for a really long time. Right. So that's right. I'm sure that's exactly what you did.
It is what I did. I was smart enough in my little brain to think, well, if I'm going to have some job forever, right, I need to enjoy it. So what do I like to do? And of course, the first thing when I wrote down was travel, right? Again, travel. So that's where my list ended. I ended up studying hospitality and travel administration. So my bachelor's degree is in travel, hospitality with a travel concentration. So my first job was like a deckhand on a Atlanta submarines in Waikiki. And I did that for like 4 months and realized that was a job, like not a career. So I ended up doing, while I was in college, I was in Denver and my dad and his wife lived up in Rocky Mountain National Park and his wife was a park ranger. So I'm like, well, I can do that. I can, military background, foot in the door, government job. So I thought I would do that to just buy some time, figure it out some more. I ended up doing it for 9 years and ended up doing
which park?
So my first park was Arches National Park. No, sorry.
Mojave I love Arches.
Preserve. Yeah. Mojave National Preserve was first. And then Arches was my first law enforcement job. And then went back to Mojave and then Santa Monica Mountains National Recreation Area, like Malibu, Thousand Oaks area of California was my long one, 7 years.
Yeah, I didn't know that the park rangers were like federal law enforcement until a buddy of mine got a DUI from one of them. But when I say a buddy, it was a guy that worked for me in the Marine Corps several years back. But federal law enforcement.
Glad you clarified that. Maybe I.
Yeah.
No, just kidding.
Yeah, it probably was you because it was in that area too. So
Unless it was the Grand Canyon. Actually, the only DUI I've ever put someone in jail for was at the Grand Canyon during my field training. So
Nice.
anyway, during that last 7 years being in California, I somehow picked up the book Rich Dad, Poor Dad. And of course, I am no different than every other person that's in real estate, right? That's where you start. And it was just this mindset shift. It's like, oh my gosh, I'm trading my time for money. There is a ceiling above me. I can only be so big. And I had this entrepreneurial spirit. I knew that. And I don't know, just many more years of patrolling and listening to Bigger Pockets and going down every rabbit hole I could find. I ended up doing the Rich Dad Poor Dad guru training program. And in 2017, I had the guts to jump. I literally quit the federal job. I ended up moving across the country to Virginia because of someone I was dating at the time. He was in the Navy, and then he got orders. So I ended up going with him, became a real estate agent as the stepping stone. That was always the plan. I never wanted to be an agent forever, but I figured I would just keep learning. I knew I wanted to go bigger, economy of scale, of course, 4 doors, which ended me up in apartments. So that's kind of my transition to, from the single family flipping idea to smaller multi to let's just go big or go home.
Yeah. I think a lot of people in this space have something similar where they get a couple single families and they realize the value they have. They realize that it's going to open a lot of doors. It's going to be very lucrative. And when they start looking at scaling, there's a lot of people who are able to scale at the single family level. But I think for most people, the natural thing to scale is, look, if you get that 24 unit, it's like buy one, get 23 free type stuff. And that's what got me into that model as well, is, trying to figure out how to scale with single family. And then I stumbled across a Bigger Pockets book about, a multifamily property. It was just like, oh, wow, light went on. But,
it's funny. I wish I could go back and figure out exactly which episode or which, series of episodes, because it was definitely Bigger Pockets that was just planting the seeds. And there was never one moment or one book or something that's like, oh, that's the thing. It was a series, but I would love to go back and see what those thought processes were.
Oh, yeah.
But remember, we met at Michael Blanc's Financial Freedom Summit, which he doesn't do anymore. He does the boot camp and in Virginia. And I ended up joining that training, that coaching program for buying apartments.
Yep.
And
that would have been 2019, like February 19, I think.
Was it 19? Yeah.
Yeah. Cause I got into the coaching program November of 18. I think that was the very next event. It may have been, I think I went to 2 financial freedom summits, but they were both in 19. So it may have been the one following that too. But
I went to 2, but that makes sense because I finished my program early 2020. But I did the program and set out to buy my first apartment. I ended up buying a 24 unit. We closed in January of 2020. So it pretty much took my whole coaching program. But honestly, during the process of the acquisitions and the negotiations and the due diligence and talking to brokers and going to Memphis to look at properties, because at the time I thought that's what I wanted to do. It wasn't that fun. I didn't enjoy it that much. But in 2019, I went to Dealmaker Live, which is Michael Blanc's bigger thing in July in Dallas. And somebody was on stage, and I don't remember who they were, but they basically said that they handle just the capital piece, the investors of the larger GP team.
Yes.
And that resonated with me. So from 2019, that summer until the end of 2019, I prepared my future to go one completely nomadic, because I sold everything I own except my car and moved to Thailand in 2020, January. But I was an agent at the time, so I had to get my team set up to take over for me, start shifting all of my clientele and my meetup and my whole platform as being an investor agent to my team. So in December of 2019, it's when, again, another big shift in my life. I left everything behind to go start something new.
Yeah. Right before COVID hit too. So I'm sure that,
Well, good thing I made a lot of money as a real estate agent, because I was living on the fumes. Well, my team, I still had my team, and they would close real estate deals and I would have money show up in my account for most of 2020. So that was nice.
Oh gosh, that's super nice. Yeah. Pat thought, that money for no work. I mean, that's what I'm trying to do, is line up as much money as possible for as little work as possible for the rest of my life. But
it's
that's the idea.
That's
Yeah.
It's the setting up
Yeah.
at the beginning, right? That was just
Mhm.
the fruits of all the labor from the years before.
Yeah. And something you mentioned that I keep on going back to, you mentioned Rich Dad, Poor Dad. And I read that I was actually on a ship between Okinawa and the Philippines. All right. And we were going there for a military exercise. And that's where I read Rich Dad, Poor Dad for the first time. Um, and he talks a lot about commercial real estate. It's kind of funny when we talk about setting things up. I remember reading about that, and I remember saying at one point, man, that commercial real estate sounds way too difficult for me. I don't think I can do that. And unfortunately, the path that I took, it took me 15 or 18 years to get into that commercial real estate. But um, I find it interesting, and a lot of ways, what you said resonates. It's like, you think you're going to like the hunt, you think you're going to like the acquisitions, or you think you're going to like the management, but when you actually start doing it, it's like, hey, I need to go a different direction, or this isn't quite, what I thought it would be. So pick it up from there, and where did you go on that one?
Yeah. So when I shifted from real
Mhm.
estate agent and closing on the 24 unit, I went full on into having a platform and raising capital. And I want to use that
Yeah.
term lightly, because when you raise capital, right, you are an operator as well. You're not just getting paid to raise
Yeah.
capital. I'm not a licensed broker dealer, but that is my main job on a GP. So I set up my website, launched that, began my platform. Like, you have a platform, you have a podcast. That's how
Yep.
people are introduced to you. I am more like one touch. I go to lots of conferences and
Mhm.
meet with people individually, but I do have a platform. I started a YouTube channel, which, by the way, I've it's there, but I haven't posted anything for like a whole year. So that tells me that
Mm.
it's probably a
Yeah.
friction point. Melanie doesn't need to have a YouTube channel.
Yep.
I'm very good at being on other people's podcasts.
Or Melanie needs to get somebody else to run her YouTube channel.
This is true.
So,
This
yeah,
is true.
yeah.
But my face has to be on there, and I have to be saying stuff. Yeah. I don't know. Maybe if the editing
Well,
was handed off, I could do it again.
something that I learned from Brandon Turner. All right, he came on my podcast and he asked for the videos, and I'm like, sure, I'll give you the videos. Anybody who asks, I'll give them the video footage. But he actually sent the video footage to somebody on his team that cut out just Brandon talking. And so if you go to Brandon's, any one of his social media sites, there's a lot of videos of just him talking, and it's not him sitting up and writing a script and talking. He got like 4 2 or 3 minute clips worth of piece of content from the podcast that he came on. So
Right.
one thing that I learned from him that I haven't implemented, I've partially implemented it. Since I saw him do that, we've started cutting our podcast up into smaller snippets, but I haven't yet, when I go on other people's podcasts, grabbed the recordings. But that's something that you could easily do, is find somebody else who could do it, run the YouTube page for you, or YouTube channel for you, and hand in the footage and just say, go find me 3 2-minute snippets out of this episode here.
Yeah, I've actually thought of doing that because I've been on a lot of podcasts, and I guess typically there is a recording of a video. I haven't thought to ask for the raw video.
Yeah,
but that's a good idea. Thank you, Brandon.
Anyway, yeah, thank you, Brandon Turner. Yeah. So. And you actually mentioned earlier, you said, I wish I could go back and figure out, what it was that switched your mind. It was actually a book that he wrote. It was at 24. The book was called like How I Bought a 24 Unit, but that was my mindset shift. That was the light for me, between single family and multifamily. That's what made me mentally jump the gap. So anyway.
So you owe Robert Kiyosaki and Brandon Turner a beer, I guess.
Yeah. Well, I actually told Brandon about it. He was at Best Ever. You were there too.
No, Dealmaker Live last
conference.
year.
Dealmaker Live. Yeah. In 2021. And I mentioned that to him. I'm like, hey, thanks for writing that book. And he just looked at me, shook his head. He's like, that's probably the worst book I've ever written, and I was kind of surprised at what he said, but, going back at it, it probably wasn't a very good book, but it unlocked something in my mind. So for me, it's one of the best books ever.
Oh yeah, for sure. And everything in life is a door. When you walk through that door, you see more doors, and you open that door and you've got more doors. So, I went from, real estate to, hey, being an agent, starting a team, and then my team makes my money instead of me, right? I've handed all my clients off to them. Then the capital, GP, co-GP, whatever, gaining equity shares of lots of big deals, getting equity shares. And now I've stepped through another door and from the capital raising world. And I can tell you how I got from capital to having a fund, but just being a capital raiser on a GP team.
Mm-hmm.
And it's just this journey of knowledge and nuggets. You follow the little trail, right? Eventually you end up somewhere. And I don't think we ever arrive. I don't know. Am I there? Did I arrive at my end? No, I think I will keep going and following the breadcrumb trails of where I'm supposed to be.
Yeah. I mean, it is interesting. I mean, I've never had a 5-year plan I've never had a 3-year plan where, inside that 3 years, I'm going the same direction that I thought I would 3 years ago. It's not because I failed in it's things change,
1 year ago, I never would have thought I would have a fund and I would be venturing into the short-term rental space ever.
Yeah.
Actually, if you asked me in December if I would do short-term rentals, I would have said no, but here I am. So it's crazy.
Gosh, I talked to somebody at Best Ever that almost convinced me that I need to do short-term rentals right now.
I'm telling you, there is something there.
There is something there, and not the vacation rentals, more of, oh, yes. This is an apartment investing podcast. We are not doing short-term rentals or advocating it. So, got it. Mum's the word, but there's a lot of goodness there as well.
Yeah. And we can talk about it. I'm mostly just kidding. So when I shifted my idea to being investor relations and capital piece of the GP stack, I'll tell you the friction that happened. So first of all, COVID happened. So let's just wipe 6 months off the map, right? Nobody was buying real estate. Nobody knew what was going on. Well, some people were, but they were scaring me. We lost about 6 months. So from February to July. In July, I started seeing some of my operators that I had a lot of respect for, would have loved to raise capital for, be on their team and do that. And been talking to them about when they have a deal, they'll call me, right? So I kind of was just like, waiting for the call, just kind of chilling during COVID. And then I saw them buying stuff and Brian didn't call me. So I called him and they're like, hey, so you got a deal that's live. Like, I'd love to partner with you and bring you some capital. And they're like, we got this one, Melanie. I'm like, oh, okay. Next one, right?
Thank you. Yeah, keep me in mind.
I saw them do another one and they didn't call me. And then I'm just like, I need more sponsors. I can't just rely on a couple people. I need like 50 of them. And that started the journey of, wow, I need to go to every conference, every virtual. Luckily, 2020 was a virtual world for us, right? Every virtual meetup. Your meetup was one of those that I started attending. And I just religiously went to meet people and network and find operators.
Yeah. I think somebody who brands themselves as someone who can bring capital, that's probably the biggest thing you got to do is vet the operators, because there's pros and cons to how you come into a GP. And, I'm going to try not to use the term capital raiser. Everybody else does, but, you obviously have to be more inside a GP than just a capital raiser. But, the more people, the more you're going to increase your deal flow. And ideally, in somebody in your position, you have several deals from several different groups to choose from at any given time. And the only way to do that is to meet more and more and more deal sponsors and build relationships with more and more and more deal sponsors. So,
yeah. And by the way, I would fall in love with operators. I think they're great. I think they have the best morals, the best values. They have a track record. They own all these properties. They're closing stuff left and right. And then there's finally an opportunity to maybe raise capital, or I hate using that word, but whatever, we know what it is, but like bring capital to their deal and bring my investors in. And they send me their underwriting. And I was like, I don't love you anymore. Wow.
Yeah.
And then that's it. I'm like, no, thank you.
You guys are really aggressive. Yeah. I actually remember talking to you about specifics on one of these properties a little while ago. It just got this little flashback from a conversation we had like 6 months ago. But so let's ask the question, when you're choosing what deal or which partners or which sponsors to partner with, what are the important things for you?
Well, first, until you know them well enough to ask for their underwriting, right? It's the person, right? The jockey is what matters the most. We bet on the jockey. We want a good horse. We want a good track. We want a good team, or whoever scrubs the horse or whatever. I don't know anything about horses, but we use that term jockey. If you have a bad jockey, nothing else matters. If you have a good jockey, everything else should fall into place. But trust but verify, right? So conservative underwriting, which is so easy to say, what does that mean? I would say everyone's a genius in the last 10 years that's bought real estate. Everyone is getting 8x $40 million returns, and everybody is retiring off of one deal, right? It's not realistic. And people are started a little while back, writing it into their underwriting, which I'm sure some economists could argue that that's okay, but I am sorry, I'm old school and fundamental. I would rather be pleasantly surprised than not get my money back or get stuck with a deal when the funding is running out and interest rates have just increased. So conservative underwriting and exit cap and rent rate, rent increases, escalations, and even expense escalations now with inflation and stuff. I even want to see more on that, but so that's a big piece, the conservative underwriting. And then market research, the market, where it is, are jobs coming there, are people moving there, households being formed, what's the supply issue there, is there a demand for the product, can people afford the rent bumps in general, just your obvious typical market research. And then I separate, there's three things: jockey, market, and the underwriting, but I pull a fourth one out and very specifically look at a deal's fee structure. If I see an operator getting paid all their money up front or in fees, I want to see what their motivation is for doing a good job with the deal. They've gotten paid. How much do they care is on the other side. So I'm okay with waterfalls having a split where most of their income comes after they've performed. So it almost comes as a bonus. But I'm seeing stuff like acquisition fee, which is normal, but it needs to be reasonable. Asset management fee, which is normal, but it needs to be reasonable. And I'm seeing a lot more capital event fees, a refi fee and a disposition fee. I've seen travel fees. I've seen construction management fees and a fee on the construction costs for the operator plus the manager. I mean, it's so all things considered, totality of the circumstances, how much are they making? Where's the money coming from? And is it in alignment with my investors at the end of the day?
I saw one recently that somebody in the tribe sent to me about, hey, I'm looking at this one to bring in capital, and they had like a 4% acquisition fee, which is a little bit high. They had a disposition fee at the end, and we start looking at all of the fees. I mean, that was the first thing that I picked out. I'm like, if you have a lot of investors who are really going to dive into the underwriting, you're going to have to answer that question a lot. Why are there so many fees? And because number one, as you mentioned, you got to align investors and sponsors' interests, and fees don't do that. And number two, the fees dilute the returns to the investors. They still had the regular split, the 75-25 split, but that was probably the biggest thing that I saw in that particular one. And if sponsors get greedy, it puts, raises red flags in the back of my head too.
Yeah. So it doesn't, and I will say, I've seen some really great deals and they will do a good job and they'll perform. They will. It doesn't mean they're bad. I just personally, because my investors, probably not all of them will even look at that or consider it. My mom, she was chomping at the bit to invest in this one deal. I'm like, Mom, slow down. She's like, but they're going to fill up. They're going to oversubscribe. I'm like, Mom, chill. First of all, that's a scare tactic. So don't fall for that. Second, who cares? Let me look at this deal. And man, it was just fee after fee. It doesn't mean the deal was bad. Doesn't mean she wouldn't get her projected returns, most likely. It just means that it feels a little greedy and I don't like how it feels.
Yeah.
I'm a feeler.
Yeah. I think there's a lot of investors. I mean, there's both types of investors. There's types of investors that are just really excited about putting money in. And quite frankly, as a sponsor, those are the ones I like the best because they don't ask hard questions. But truly, when I come to invest, I'm the one that's looking at stuff like that. I'm the one that's saying, wait a sec, you guys are charging a 5% acquisition fee? Hold the boat, type stuff. So I look at it, and I know a lot of people do. I think the more intelligent investors do.
They do, and it's interesting because some operators, they're good operators, but they're the ones with these crazy fees. Why? Because they have a huge platform, thousands of people in their database, and they're like, oh, you want to ask questions? You're not our investor. They just want those people that just rush to send the money. And that's
Yeah.
fine. Good for them. Good for them. I hope
If
they
you
do
can
well
it.
by the investors.
Yeah. And if you can
Which, by
keep
the
doing well.
yeah, I want everyone to do well by their investors. Why?
Mhm.
Because it will taint our industry if they start losing investor money. I don't want anybody to ever lose investor money. I want them to excel and make a bunch of money if they're doing right by the investors. But as an investor, if you can invest in deal A, pay a bunch of fees and get your mediocre return, or invest in deal B that's a little bit more fairly put together, and you can 3x your money instead of 2x it in 5 years or whatever.
And something else. I mean, a lot of people have got turned off of like the financial industry right now as it currently sits because of the high fee structures, and one of the benefits of multifamily in my mind is you come in and you're not paying as much of those fees off. I mean, of course, there's the GPLP split, but I mean, the way I look at that is, I mean, Coca-Cola, if you invest in Coca-Cola stock, I mean, they're making their money, before it hits the stock prices too. But it's similar. You're just not paying that financial advisor, 3% portfolio fee every year, or something like that. But anyway, let's shift gears slightly because we're the time that the clock keeps on ticking. And I really want to talk about the funds. So talk about what made you decide to do funds and or get into the fund model, and kind of pros and cons of that.
Well, when I was struggling to find GPs that wanted to bring brand new Mel who didn't know how much money she could raise into a deal, right?
Mm-hmm.
So I wasn't getting invited to a lot of deals because they're like, oh, you want code GP and you don't know how much money you can raise, pound town girl. So that I struggled. It took me a year and a half to do my first deal. And by the way, my first deal was not a code GP. It was an SPV. So the reason I knew about the SPV is one of these virtual conferences I went to in 2020. I think it was best ever, actually. Hunter Thompson had a presentation about the SPV, which stands for single purpose vehicle. It's also a single purpose entity, or you can call it a fund of funds. I've heard people refer to it as a fund to funds. They're basically all similar. It's a business put together for the purpose of putting capital together and investing in one investment. It is a security. It's going to be a 506C or B Reg D filing, and it's going to be some sort of exemption, and it needs to be filed and treated like a security because it is. So I formed my first SPV because I didn't know how much I could raise, but I linked arms with a couple other partners, and the three of us set out to raise $1 million, right? So when we go to a sponsor and say, hey, we're going to bring you $1 million check, they'll talk to us. But if I said, hey, I want co-GP and I don't know how much I can raise, then you don't get invited. So because we were guaranteeing $1 million check, they took us in. So from the SPV getting that one done, that put me on the map. Now I've tested my database. I have an idea of how much capital I can raise and how much my investors trusted me and like what I bring to them. And then I could go back out into the world. Now the SPV is a one-time deal. It's a single purpose. You raise, you create the entity, you get the PPM, you do the deal, and that's it. That SPV is done. So the next thing I was going to do, and I was kind of learning about the fund model then, I kind of got my feet wet with the SPV, and now I could wrap my mind around a fund. And what funds are sometimes they're blind, meaning you invest with an operator, they buy and sell real estate inside of the fund. You don't know exactly what they're buying and selling. You just kind of know what types of real estate they're doing. But the fund I chose to work with it's customizable. And people invest in the fund, which is an underlying, it's the one PPM, it's the one fund, but there's a software program that overlays. And when they go into the fund, now they have to allocate their funds, their money via a software program to a specific deal. So I could have 3 or 4 deals in there, and they can buy, instead of putting 100 grand in one syndication, they could put 25K in 4 syndications, be diversified in asset classes, geographies, sponsors, and even investment strategies, more cash flow, more equity upside, maybe more risky or more stable, whatever. They can diversify their own portfolio, like Robinhood for stocks, it's Robinhood for syndication. So that's the model I went with. And I love it, but a fund is, lots of investors coming together and that fund investing on behalf of the investors. So
And something that we've talked about earlier, the whole capital raising piece. You can't just be a capital raising in a GP. All right. How is that different when you're using either an SPV or the type of fund that you have right now?
So far with the SPV and with the deals I've done in the fund, I have had co-GP shares. So that doesn't require, there's an exemption if you are what is it called? You would have to register with FINRA. You have the SEC and you have FINRA, two separate governing organizations. And if you get into the advisory role, meaning you're investing on behalf of other people, and you don't have a GP share, then you have to file an exemption to that registered agent thing, right? But so far I've been a co-GP on all of our deals, and now I'm doing more joint ventures than just syndications because the fund is the security. I can now joint venture with the fund. It's a beautiful thing. So I haven't had to register have that exemption to the advisory role under FINRA. So for us, it's just been the management company is the co-GP, the fund is the LP, and that nexus doesn't require that. It's just a normal syndication. So did I answer your question, or does that make sense?
Absolutely. Absolutely. I mean, in a nutshell, you've got a lot more flexibility with the fund and now I guess we can call you a capital raiser, right?
I'm a fund manager, private
fund
equity
manager. Right.
I'm still not a capital raiser. I'm not getting paid in relation to how much I send the check for, right?
Yeah, and actually there are a lot of laws on the fund manager piece, and my understanding is it's similar to like the 506B, 506C, where you file exemptions to why your securities don't have to be registered. I understand it's a very similar concept with the fund manager inside the funds, where you fall under some exemptions that allow you to manage a fund without being like whatever the certification is. I don't even know.
Correct. So it is a Reg D filing, a 506C for my fund, a 3C1. So 506C, 3C1.
Yeah.
So we max at 99 investors.
Yep.
There's some restrictions to it, and it's real estate only, pretty much. There's a few restrictions.
Yeah, this is one reason I really wanted to talk to you today is about this, because it's a blind spot for me. I know there's 3C1s and 3C7s. I can never keep them straight. I just know that there's a lot of similarities between it. But anyway, we are about out of time. So let's ask one final question for you. How can listeners learn more about you?
Oh, I thought you were going to ask me what my burning why was.
Oh, I didn't ask your big burning why. Okay. One final question for you. What's your big burning why?
Have you ever heard of the 7 levels of the why, right? When people are like, oh, yes. Why? Well, my family, or I want to travel. Yeah. So why? Why do you want to travel? Well, because the world is interesting. Whatever. Dig. Keep going down. So I'll tell you my burning why.
Which level of your burning why? Is this level 4 or is this level 7?
The deepest I can go. So the highest level was, I just want to have freedom to travel, move about the world, experience cultures, and have a very interesting life. That was what I thought my why was, right? But after somebody in front of a room full of people, it was actually my M1, what you're going through. Yes. In front of everybody, she just kept, well, why, Melanie? I'm like, well, why? I was like, I just wanted to cry. I'm like, oh my gosh, you just stripped me down. I just want to be the best human, well-rounded, adjusted, non-judgmental human on this earth. I want peace and I want love. And how I do that, why the travel led to that, is because I want to travel to experience cultures, to not just be this ignorant American, right? But get out in the world. I've been to India, I've been to Thailand, I've been to a lot of really wacky places that, how am I going to say Americans have the best way of life? You go to India, that place is so chaotic, but everyone is so happy. So anyway, my why is, why do I want financial freedom? Why am I doing all of this? Why? So I can explore myself more, connect with God, experience the world, strip myself down to whatever I am without the facade, without the fame, without the money. Who am I? And just sit with myself and be a beaming like ball of light and love. Is that really woo-woo or what?
Yeah, that was the most fantastic why I've ever heard, so even if it was a little bit woo, and there's a lot to it. I mean, there's always a deeper why, and if I really peeled mine down, I did have somebody, do the same thing with me once. And fortunately, it wasn't in front of a big group, it was in front of a small group. But I think, that there are several different levels. And, for me, there's the why that I tell everybody, but I know what a couple levels deep are. And a lot of them for me are very very personal, so, and
The
part
raw
of it is the
human,
same. Part of
the
it is I
raw,
want to be the best person that I can be for
yeah,
lots of reasons.
but you can't be the best you could ever be without big challenges
Mhm.
and big wins and big losses and lots of tears and lots of laughs. Like it's
Yeah.
everything, right? It's not,
You've got to get bigger. You got to grow. You got to be able to handle larger and larger things and larger problems, and that's how you become the best. You don't become the best you can be by not challenging yourself,
yeah.
so
I think you expand
yeah.
so you can contract and sit there and just be.
Yeah. Awesome.
Yeah.
All right. Now, the real last question of the podcast. Thanks for reminding me about that one. I can't believe it. I've gone, 250 something episodes asking it every single time. Actually, my daughter's reminded me that I've missed a couple of them. But the real last question, how can listeners learn more about you?
I mean, my website, Freestyle Capital Group, is a good start. I'm on social media everywhere. I'm on, if you Google me, you'll start finding me. I've been on quite a few podcasts. I'm at lots of conferences. So if people see me at a conference, they just need to roll up and say hello. That's it.
Yep. Awesome. And I look forward to seeing you at numerous conferences and next time you're in Idaho Falls again, of course. And if I'm ever in Austin, if you're still living in Austin.
I am in Austin for now.
For now.
I think I'll be here for a while. I just got my Texas driver's license today.
Yes. So at least for another 3 or 4 weeks, you'll be
at least.
At least. All right. Well, hey, thanks for coming on this show. I very much appreciate it.
Thank you.
Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans yet, you are missing out. So get yourself 30 days free by clicking the link below in the description or go to thetribeoftitans.info and we'll see you there.